Charlie Munger's advice to new investors. Let's go over it. We're going to take it from this article right here from the Wall Street Journal where they did a 6-hour interview with him recently. And he's an old dude. 6 hours is a long time. And this was May 3rd, 2019. So it's actually not recent at all. But they cover a lot of topics and a lot of them are evergreen, including his advice to new investors. And Charlie Munger, by the way, is Warren Buffett's partner. And there's a ton of people who actually consider him the brains of the operation. Everyone loves Charlie. He's another investing legend. And like I said, supposedly the smarter of the two. Not that Warren Buffett is dumb or anything. So one of the first questions they ask him is, if you were just starting out as an investor, what approach would you take? So Charlie says that the original Ben Graham approach of looking for cases where you're getting more than you're paying for is correct. That's what all good investing is. And really, you're just looking for it in different places, just like a fisherman can fish in one place or another. But the idea of getting a value, underpaying for what you're actually getting, that's never going to go out of style. It's just basic and fundamental. And there's a lot of different ways to do it. Some people look for it in stocks where earnings are going up all the time. Some look in consumer goods. Some look at bankruptcies. Some people look at distressed debt. There's different ways to hunt, just like different places to fish, and that's investing. So as a new investor, you're going to run into a bunch of different trading and investing styles. But the thing to keep in mind is that the basic principles of investing apply to all of them. Just like Charlie is talking about value, and he's a value investor like Warren Buffett, but the same stuff he's talking about can apply to momentum investing, which is what I do, for example. So if you're just starting out, you should test some different styles and see which you like the best, because there's no one way to do this. Like he just pointed out, there's a ton of different ways. And because there's no one way, there's no one right way. The right way to invest is going to depend on you. What matches your personality? What do you feel comfortable with? The only wrong way to invest would be to get into something just because it's popular, even though it doesn't fit your natural style and personality. That would be wrong, because it's not going to work out. So when you're starting out, look at a few different styles, test them out, see what you match with. And then once you find one style, stick with it. Get just really good at that one style, because investing isn't easy. That's going to be a tough job in itself. But if you think you're going to be able to do value, momentum, distressed debt, all these different things, well, it's not going to work out. At least in the beginning. There are some amazing, incredible investors, mostly the macro guys, who are able to go into every different field. But that takes years and years of learning, because even them, they still got to get good at each thing individually. So focus on one style, learn the fundamentals, learn the principles, get really good at that style. And then if you want to progress to other styles and doing a multi-strategy portfolio, well, it'll be easier. But only once you have those underlying principles, which you're going to learn by focusing on one style first. And Buffett and Munger, they pretty much stick to one style too, right? Value investing. They express it in different ways, but it all comes back to one thing. And they don't move outside of that. So Buffett and Berkshire, Charlie, they missed the huge tech trend, the run up in the 90s. And their fund underperformed, but they didn't care, because they knew what they're good at and they stuck to that. They didn't let any FOMO creep in while watching these huge returns in the tech space, which, by the way, FOMO is a huge problem in trading. And if you're a new investor, you definitely need to learn how to control that along with your other emotions, because any style of investing you're about to do, your emotions are going to get involved and you got to keep them at bay. So you can get our free guide that will help you do that. The link is down below in the description and comments. So Charlie continues. He says, of course, one of the tricks is knowing where to fish. So Li Lu, who runs Himalaya Capital Management, has made an absolute fortune as an investor using Graham's training to look for deeper values. So Li Lu, if you don't know, is this guy. I think his story is that he was inspired by Charlie Munger's speech and became a value investor, and he's really good at it. Charlie is invested in his fund, which runs like 10 billion, I think, and he's one of the front runners to actually take over for Buffett when he steps down. And you can see he's so good at value investing, he can get away with this terrible website with what, clip art mountains? Is this supposed to be the Himalayas? Incredible. This is how you know he's good. So as Charlie said, Li Lu uses deep value investing, but he focuses on China and Korea. That's where he likes to fish. And if he moved outside that, Charlie says his record wouldn't be as good. He said there are a lot of wonderful, strong companies at very cheap prices over there. So as an example, one guy in Korea cornered the sauce market. He had 95% of the sauce in Korea, and he couldn't stand anybody else ever selling any sauce. So if he owned the whole market, he controls all the pricing. So if he raised prices, he could make 2 or 3 times as much. So Li Lu was all over that. It was a company called Otagi. I think that's how you say it. And Charlie and Li Lu, they all made 20 for 1 over there with that company. And he's saying there is nothing like that in the United States. So this is another example of Li Lu sticking to his strategy like we were talking about before, but also making sure that his strategy matches up with the correct market. So that's another thing you got to consider as a new investor. Once you pick a strategy, you need to make sure you stay in the right environment where that strategy works best. So if you decide you want to do value investing, like that matches with your personality, then you're not going to be looking at high-flying tech names. That doesn't make sense. You're going to want to look for beaten down stocks that everybody hates, that everyone has written off, where you can go in and do an analysis and find something different. You're going to be more of a contrarian. Same thing for me on the opposite end of the spectrum. If I'm a momentum trader, which I am, then of course I'm going to be in stocks like Tesla and Apple and things like that. And even for my momentum strategy, we did an analysis trying to figure out which index it would work best on. The S&P, NASDAQ, Russell, where does it work best? We found that it works best on the NASDAQ. So once we figured that out, we didn't move away from the NASDAQ. We placed the momentum system on just those stocks because that's where we're going to get the best returns. That's where we should be fishing. Another example is at our research company, MacroOps. It's a global macro research company. So Alex, our lead portfolio manager there, likes looking at commodity plays because he's able to figure out long-term commodity trends with his macro research. So one of the places where he does really well is in the oil sector because oil is something he tracks closely. So there's been multiple times where oil has been beaten up too much, and then the oil producers and all the companies in that space have been left for dead. And it's at those points where Alex jumps in, buys up those stocks, and then sees them launch up 300% in a few months as things correct. So in that case, he's sticking to a strategy too, because he's not looking at any value stock. He has a specific lens that he looks at it through. So uranium is another thing that he looks at, uranium stocks, because he's able to see the trend on that commodity as well. So you got to stick to what you're good at or what you want to be good at and make sure you're fishing in the right pools. And there's always going to be temptation that's going to try to lead you into something you shouldn't be in. Like whenever I read value stuff, I start getting excited and I want to put money in. But I'm a momentum investor, so that doesn't make sense. So I got to stop myself because I don't know what I'm doing in value compared to momentum. I need to stick to my thing. So once again, something like the FOMO guide helps me do that and control those emotions because it really does happen a lot. You'll experience it, especially as a new investor, where you'll see your buddies jumping in on some trend that you weren't in on and you want to jump in too, even though you might not know what's going on and it doesn't fit your strategy. And yeah, sometimes that'll work out, but a majority of the time you're going to end up losing money because you fell victim to that temptation. So check out this guide. It can help you with that FOMO and your other emotions. Just go to this page. There's a link down below in the description and comments. Put in your email and name and I'll send it over to you for free. It is free, so you might as well check it out. And if you haven't already, make sure you subscribe to this channel and hit that notification bell so you get email notifications of new videos. We're publishing a bunch of them and we're going to do more on Charlie Munger too because there's a lot more in that interview. So subscribe and we'll go over more next time. Stay fallible out there. Bye.